Three high growth stocks that I'm buying. The first one is Elf Beauty. Now, Elf is up 57% in the past year. And Elf is like a makeup company, so it's a makeup and cosmetic company. The Elf stands for eyes, lips, and face. Now, their growth rates are insane. Their net sales went up 77% year over year. Their gross margin went up 330 basis points. Adjusted EBITDA went up 101%, and their market share increased by 305 basis points on a year over year basis. So this is their 21st consecutive quarter of net sales growth. Look at these numbers: 78%, 76, 76, 85, 71. Like, no average company is putting up these kinds of growth rates. And while their cosmetics consumption has actually gone down in its industry, Elf Cosmetics has actually gone up 30% on a year over year basis. Elf also moved to the number 2 rank in the dollar share spent in the beauty industry, and also it went up to the number 1 in the unit share that was bought. Also, while the skincare consumption only went up 2% on a year-over-year basis, Elf 19x that and went up 38% from the average industry. That's insane. They increased their international by 115% on a year-over-year basis. That's insane. Elf holds the number 1 or number 2 position in 18 cosmetic segments, and they only hold number 2 in 5 of them. And Elf still has much room to grow with their dollar share. They only own 1.6% of the whole skincare industry. And Elf's marketing is just insane. They partnered up with Liquid Death, the drink company, and in 45 minutes their products sold out. They had a triple-digit lift in their site visits. They had 12 billion impressions and 68% of new purchasers. And Elf owns the number 1 dollar share in Target at 19.3%, while the national average is 10.5%. This means that they grew 70% on a year-over-year basis. And Elf has expanded to new countries like Italy, where they quickly rose to the number 1 brand, and they have lines down the block when new stores are open. And they did the same thing with the Netherlands. They hold 1.13 billion in assets and 486 million in liabilities, and they doubled their net income on a year-over-year basis. Now, Elf trades at a forward PE of 54, which does seem expensive, but if you remember their growth rates, their net sales are growing 70% on a year-over-year basis, so I think these numbers from earnings estimates are way too low. And as we can see here, revenue on a year-over-year basis grew 77%, and diluted EPS grew at 99% on a year-over-year basis. The next company is Palantir. Now, Palantir is up 52% in the past year, but if you look at their growth rates, their commercial revenue grew at 27% on a year-over-year basis, and their US commercial grew at 40%. And their total revenue grew at 21% on a year-over-year basis to 634 million, and their adjusted operating income was 226 million, going up to a 36% operating margin. Their US commercial customer count grew at 69% year over year. That is crazy. That's literally half of their business last year. And their total customer count grew at 42% year over year, and their commercial customer grew at 53%, so basically half of what they had the year before. Palantir's AIP Bootcamps has brought a lot of growth, right? So their flywheel marketing strategy, which is just when happy customers refer others and the cycle repeats, as we can see with General Mills, they say we're saving about 14 million annually, and it's only deployed to a part of our network. So in the future, just imagine how many growth aspects Palantir can have in the next 10 years. They achieved their 6th consecutive quarter of GAAP net income, and they have a rule of 40 of 57, which is their combined revenue growth rate and profit margin. Their adjusted operating income keeps growing on a quarterly basis, and the same with their operating margin. And they have a 5.01 current ratio. That is very good. They have 4.8 billion in assets and 945 million in liabilities. Palantir trades at a forward PE of 82, but I think it's justified by their future growth potential. I think these estimates are way too low. And if we look at this, they're growing their US commercial customer count by 69% on a year-over-year basis, and they grew their US commercial revenue by 40% on a year-over-year basis. Now, the next stock is Meta. Now, Meta is up 43% in the past year, but if we look at their revenue, they grew at 27% on a year-over-year basis, Their operating income was up 91%, and their net income literally more than doubled at 117% on a year-over-year basis. They have 222 billion in assets and 73 billion in liabilities. Now their family of apps, which is like WhatsApp, Facebook, or Instagram, has now 3.24 billion daily active users. That's insane. That's almost half the world. They grew their free cash flow almost double again, like their net income on a year-over-year basis, so 12.5 billion in cash. Also, their app Threads has been increasing consistently, and just imagine the monetization opportunities that they could do by like putting ads on their platform, because once it gets scaled enough, then this can actually start giving them a return on investment similar to how Instagram and Facebook do if Threads ever came to that. Meta trades at a forward PE of 23, which I think is way too low because their earnings estimates are only saying that they're going to grow their sales by 17% in their fiscal year 2024. But remember, their revenue was growing at 27% on a year-over-year basis. Income from operations was up 91%. No average stock is putting up these kinds of numbers. And then the S&P 500's forward PE is about 22. So that's only one lower than Meta's. But Meta's growing their net income by 117%. That doesn't make any sense. And so with all this, I'm just dollar cost averaging into all the stocks. I'm not trying to time it. I'm honestly hoping all of them go down so I can buy more in the short term, because I'm looking at the fundamentals, and I think in the future, years down the road, these companies will yield a really good ROI, or return on investment. If you found this helpful, I appreciate if you like or subscribe. Thanks for watching. J Money out.